Good morning, everyone. Thank you for joining us for our annual update. This is our Outlook 2023 presentation with David Waddell, The Power of Perspective, What Could Possibly Go Right. I'm Sean Gould, a senior wealth strategist and one of the partners here at WNA. For the next 50 minutes or so, our CEO and chief investment strategist, David Waddell, will present his update on the current economic, market, and political conditions. For those of you joining us for the first time, Waddell & Associates is a wealth management firm dedicated to enriching life by providing clarity. Our host, David Waddell, is great at cutting through the financial fog and is often featured as an expert on CNBC, Fox Business, Forbes, The Wall Street Journal, and Barron's. With that, I will toss the screen over to David Waddell.
Thank you, Sean. Good morning, everyone. It's exciting to be with you. Thank you for clicking in. Quick round the house thank yous. Everybody at WNA has touched this presentation and contributed in some way. So thank you to Teresa Bailey and her team for help getting all this content out. Nicole for beautifying all of this. It's an amazing presentation. So prepare to be amazed with the graphics. And also Derek, my cameraman. Apparently it's working. So thank you for that. Lainey for making sure I'm where I'm supposed to be all the time. And everybody else at WNA, even T for keeping me compliant. And heck, I'll throw it out to Sailor who bought me this tie for Christmas. So it takes everybody's contributions to pull off something like this. And I've got a whole lot to share with you today. And I think it's kind of amazing. This may be the largest, I've done this for 20 years. This may be the largest live audience, at least, we've ever had. And I suppose that's a bit unsurprising because I have never seen such extreme divergence of opinion in a market environment before. Is it recession? Is it expansion? Is it a hard landing, a soft landing? Is it no landing? Is it a bull market? Is it a bear market? Is it war or is it peace? Seemingly everybody right now has a different perspective. And yet we're all looking at the same data sets, which is why I've titled this presentation, The Power of Perspective. But unfortunately, in times of uncertainty really is a petri dish for pessimism. And right now, pessimism is pervasive. And as I went and dug through and did all of the analysis, I had to ask myself, given all of this pessimism, what in the world could possibly go right? And I'm going to share that answer with you at the end. So do stay tuned for that. But let's do a quick survey first on what people think right now, or thought specifically as we turn the calendar from 2022 to 2023. Well, according to the economists, we're going to have a recession. So this is a survey of economists going back to 1968. And as you can see, 45%, or the economists as a group placed a 45% probability on recession. Doesn't seem like a lot, but it's a whole lot more than they've ever forecast in the past. So conclusively, economists expect a recession. Also conclusively, consumers expect a recession. This is the University of Michigan Consumer Sentiment Index, and you can see at 59.7, the mood is typically where it is, right around the bottom of recessionary periods. So consumers are pretty pessimistic on the economy. Professional investors who get paid to figure this stuff out are also very pessimistic on the economy. In fact, only 20% of professional investors surveyed expect a stronger economy in 2023 than 2022. And that has led to record investor pessimism. So I refer to this a lot in my weekly emails, maybe you recall. This is the AAI Sentiment Survey Index, which really just polls home gamers, people sitting at home, average retail investors, and says, how bullish are you over the next 12 months? Bullish meaning they think the market's going to rise. Well, in 2022, they were the least optimistic on average about the next 12 months than they've ever been. So only 25% of investors polled at the end of last year felt like 2023 would end up being a good year for the economy or a good year for their investments, leading most people to think as we enter 2023, what if 2023 is just like 2022? Well, if it is, that would be really bad because 2022 was one of the worst years for diversified investors we have ever seen. So in this chart, what I've done is I've paired returns on the S&P 500, the stock market, with returns on the US 10-year Treasury yield as a proxy for the bond market. And I've gone all the way back to 1872 and said, okay, what do those combinations look like in any given year? So for orientation, in 2008, stocks were down almost 40%. That's terrible. But fortunately, if you were diversified and owned some bonds, your bonds were actually up over 20% to provide a little bit of insulation and an offset to that down force from the stock market. When you look at 2021, that situation was a bit inverted. So the S&P 500 went up almost 30%, but bonds lost about 6%. So it dragged down the return you got on the S&P overall, but it did provide diversification. Seldom, but sometimes you see environments where both stocks and bonds are negative. And here are just a few of them: 1969, 1917, 1907, and 1931. And those were environments that were pretty difficult for investors, but they pale in comparison to what diversified investors had experienced in 2022. Never before had the S&P fallen 20% and the bond market fallen about 20%. So there's a reason why people are pessimistic and fearful that 2023 can look like 2022. That's because 2022 was one of the worst years ever for diversified investors. So let's go back 365 days or so and see what we were thinking going into this, where we grade ourselves. It's proper for accountability. So I'm going to take you back into the framework of our Outlook 2022 presentation, which we titled Clear for Landing. Here was the thesis. The economy had been so overstimulated by the Fed and Congress. They pumped in $10 trillion worth of stimulus into a $20 trillion economy, which was lunacy, but it created a whole lot of momentum. And then obviously inflation followed, and the authorities needed to guide us back down to a more normalized environment, maybe in 2023, maybe in 2024. And so we were trying to figure out what that glide path was going to be back toward normalcy. And we expected three major turbulences for investors and market participants. We expected inflation to be a major issue. We expected valuation across the stock market to be a major issue, and the bond market. And we expected governance issues, especially around the mid-term elections, to be a major issue. So here is what we expected from each one of these variables last year. We expected that COVID inflation would prove to be wartime inflation and not the Great Inflation 2.0. Just for review, the difference between wartime inflation is we get attacked by COVID, we pump $10 trillion in the economy, COVID goes away, we take that money away, or we move forward without doing it again. Great Inflation 2.0 is policy inflation, where we're constantly stimulating the economy on the fiscal side, the monetary side. We didn't think that was the environment we were really in, and we figured that inflation would come down. Now, that glide path was a little bit more extended because of the invasion of Ukraine by Russia, but we still see that as a wartime kind of inflationary episode. And inflation actually has fallen 30% over the last 6 months. So the peak in June was 9, we're at 6 and change. So inflation has shown some signs of being temporary. In terms of valuation, what we did know from doing our homework is that when inflation rises, valuations across asset classes fall. And when we surveyed the universe, I'll spend a little bit more time on this, what we found was the S&P 500 was very expensive, which was bad news. The good news is everything outside the S&P 500 was pretty cheap. And so what ended up happening is valuations did fall to an historic degree, and the S&P 500 did actually underperform those lower valuation areas outside the S&P 500. So that proved to be correct. So we're 2 for 2. On last turbulence, governance, which is always fun to forecast, we expected that the Fed's bark would actually end up being worse than its bite. And we thought that because of President Biden's inflationary agenda, which was really ticking everybody off, specifically at the gas pump, it would cost the Democrats the House and then maybe even the Senate. We were wrong about the Fed. The Fed bit just as hard as it barked. And we'll spend some time talking about that. The Republicans did not win the Senate, but they did win the House, which puts us in political gridlock. So we get, credit for that. So really, we had a pretty good track record of predicting what happened last year outside of how aggressive Jerome Powell and the Fed was. So here's what we said was going to be the bottom line looking into 2023 as we grade ourselves. We said equities would be moderately higher, which is a pretty lukewarm forecast for an optimist like me. But here's the reason why we defaulted to the upside on that. If you go back and you look at interest rate hiking cycles from the past, and I think there are 12 of them or so on this slide, markets actually tend to rise during interest rate hiking cycles. Why? Because the reason that the Fed is hiking interest rates is because the economy is cooking along, earnings are cooking along, inflation's cooking along, and it feels like it needs to bring things down a little bit. So actually, they're hiking rates because things are good. They're not hiking rates because things are bad. And there were a couple of instances, 1994, 1995, where there was a Fed surprise, and then 1973, where markets were down 13%. But overall, the return profile in a hiking environment was pretty benign, except for last year. This time it's different. Last year, the S&P 500 fell 18% in 2022. So obviously, equities did not go moderately higher. They went significantly lower. But we were a little bit nervous about that. And so we figured out a way within the portfolio to hedge and be a little bit more defensive. And we did that by portfolio positioning. And I'll share some more on this. We thought small caps would outperform large caps, so we weighted the portfolio towards them. We expected the value style of investing to outperform the growth style investing, so we weighted our portfolio more towards that. And then we expected internationals actually to outperform the US. And here was the thesis behind that. What we know is, again, when inflation rises, valuations tend to fall. And so that's what I'm showing you on this chart here. I'm giving you the average S&P PE ratio on the left-hand side paired against different levels of inflation on the x-axis or the line below. And what you can see is in 2020, we were really running a PE of 20 or so on the S&P. This is average PEs. And with inflation rising up to 7% and change on average in 2022, there was a lot of valuation downforce in the market between obviously the low inflation environment in 2020 and the high inflation environment of 2022. And so we had to draft a strategy to get out of the way of that valuation compression. So we went and we looked at the market and different factors. And what I'm sharing with you here is the style value blend growth within the S&P 500 combined with the size, small cap companies, mid cap companies, large cap companies, and the valuations relative to the 20-year average. So what you can see in red is that large cap growth was trading at a 65% valuation premium relative to its 20-year average, while small cap value was selling at a 6.5% discount to its 20-year valuation. So if you're trying to avoid high, valuation areas of the market, you want to tilt down and to the left. And if you look at what was going on between domestic stocks and international stocks, the valuations were even more compelling. So if you look at the PE as we ended the year in 2021, it was about 21 times. If you look at the world outside the S&P 500, it was about 14 times. You do the math on that. That means international stocks were trading at a 33% discount to domestic stocks as we entered 2022. And so this is the way we constructed our portfolio to try and avoid that valuation compression as much as possible. We had 40% of our geographic exposure outside of the US towards those international areas. We had 45% of the portfolio outside large cap equities, so small and mid caps. And then we only had 20% of the portfolio. You never go 100% one direction or the other. That's dangerous, but we were tilting pretty aggressively away from US large cap growth. And when you total that all together, we only had 7% of our portfolio allocated to the FANG stocks, to the large cap US growth names back in 2022 as a mechanism to avoid that valuation compression if it occurred. That's by far the smallest allocation we've had to that box certainly in the last 25 years or so, actually probably in the entire life of the firm. And so that was a deliberate way to avoid some of the drawdown we saw in the PE ratio, or we expected. So did it happen? Did the PE ratio collapse? Yes. In 2022, the PE ratio within the S&P 500 actually fell 30%. Ironically, earnings grew last year, right? And so you had valuation compression and earnings growth. And the combination of those two obviously led to that 18% drawdown in the S&P. So we did see that valuation compression. And did the strategy work to try and avoid some of that damage? It did. Here were the returns for those same boxes. Large cap growth was down 30%. I think the NASDAQ was down 33%. If you looked at profitless tech companies, they were down like 65%. And then you got the Bitcoins and people down 70%. The SPAC stuff has gone away. So a lot of that ridiculous, silly valuation stuff got burned off. If you had lean towards value, which we did, you had a little better experience. You can see value on the average there was down about 11 or 12%, certainly better than the 18 for the S&P and 30% for growth. And in terms of the geographic returns, this is a little bit mind-blowing. We had a war in Europe. We had shutdown policies in Asia, specifically in China. And yet, even in an environment where the dollar strengthened, and I'm going to talk a little bit more about that, which would be good for US equities, ex-US equities actually outperformed last year. So they were down about 14% and change against the USA down around 18%. So the right play for 2022 was not to be invested at all. That's not really practical. But if you were invested, the right play was to avoid the high valuation areas of the market, which we did. All right. We expected the dollar would fall last year. We're in a pretty substantial uptrend in the dollar as we entered 2022, but really we had been treading water for the last 5 years. Then what happened? Russia invaded Ukraine. The world got very nervous. They stuffed the United States with all of their excess cash. They tried to get out of Europe because who knows, maybe we'll have a tactical nuke. And that's forced the dollar up significantly from about 95 in this dollar index to 115. That woke me up in the middle of the night. I sort of had a pain threshold around 120, and here's why. This is an article that was written in the New York Times right about the time the dollar was peaking, saying a strong dollar is wreaking havoc on emerging markets. A debt crisis could be next. So the fear I had last year was really driven around sovereign debt defaults. Remember, we had issues in the UK around this time. We had issues in Sri Lanka. We had issues in Spain. We had issues. We had problems popping up around the globe around this time. And for those of you who recall, in 1998, we had a currency crisis in Asia that sparked in Thailand. It ricocheted over to Russia. It went from Russia to New York and took down long-term capital management. Markets went down 20% almost overnight. And Greenspan had to come in, rescue the system, provide a bunch of liquidity, and we went on to the rest of the bull market in the late 90s. But that was a significant event driven specifically by a sudden rise in the dollar, which can be very, very troublesome for nations that borrow in US dollars. Fortunately, right around this time, which is about my birthday, we got a benign inflation report, and the dollar went down sharply into year end, ending the year about 103, 104, which is frankly kind of where we are today. But as the dollar came down, it relieved a lot of pressure on the international system. So for those of you searching for a reason for a credit crisis, the dollar, I think, is the fulcrum there. So this is something we watch closely, but a whole lot of relief having come down from 115 to 103. In terms of US interest rates, we expected the Fed to raise interest rates. We expected inflation to irritate bond investors. So we expected rates would be moderately higher. Here's the yield curve as we entered into 2022. You can see it's naturally sloped, low on short-term rates, high on longer-term rates, but really the rate structure itself was very low, the 10-year trading at 1.5%. By the end of the year, things were dramatically different. In reaction to the Fed's policy response, short-term rates were all the way up to 4.75%, and long-term rates were 3.97% out on the 30-year, which just means the curve shifted up and it also inverted, which is kind of a double whammy and obviously very difficult for bond investors. And we expected bond returns to be, negative. We expected bonds to be dead money, maybe you break even. Actually, what happened in the bond market, we positioned ourselves pretty defensively to try and avoid all of this carnage. But if you look at what happened in the bond market, it was abysmal. It was Armageddon. So here are the worst returns ever going back to the 1800s for certain segments within the bond market. So long-term investment grades in 1842. I don't know if y'all remember that. I'd have to open the textbook to figure out why, but market returns for long-term investment grade bonds were down 30%. 1980, Fed was hiking rates. Long-term treasuries were down 17. Total bond market was down 9. And then in 1994, when the Fed surprised markets and raised rates, intermediate term US treasuries were down about 6%. So that's as bad as the bond market has ever gotten for those kind of categories. Here's what happened in 2022. I mean, it was just abysmal. So long-term corporates and treasuries were down about 30%. Total bond market was down 13, and intermediate term treasuries were down about 11. So it wasn't a year of dead money for bonds. It was the deadest money in history for bonds. And then the primary threat was really that Jerome Powell's bike would be as hard as bark, and he would be more aggressive than we expected, wreaking havoc through the bond market, and that ricocheting through the valuations and therefore into the stock market. And to understand why Jay Powell was so aggressive last year, let's take a moment to try and get his perspective on things and crawl inside the Fed's head. Now, we're all, vain individuals, including the chairman of the Federal Reserve. And the chairman of the Federal Reserve knows that his legacy is always at risk. And so faced with inflation, Powell had to make a decision. Number one, did he want to channel Paul Volcker, who is viewed as a hero for breaking the back of inflation from the 1970s and the early 80s? Or did he want to be the zero that Arthur Burns, largely accredited as the worst Fed president in history, because he actually created the inflation in the 1970s. So you can either be a hero because you are extreme in your austerity like Paul Volcker, or you could be a zero because you will let inflation get away from you. So there were several times in Powell's speeches last year where he channeled Paul Volcker, and that's the way he acted. I have never seen a Fed chair, of course, I wasn't really paying attention in the early 80s to what Volcker was really saying, and I don't even think we had cable television. I'm not sure you could even watch what Volcker had to say, but I'm sure he said some mean things, but Powell said a lot of mean things last year. I mean, he used policy guidance, which is a policy tool, to talk as tough as any Fed chair probably ever. I mean, at one point, he was channeling Clubber Lang from Rocky III, saying, "My prediction is pain." He actually did say that. So what's he going to do? If you're comparing yourself to the others and you want to be seen as the most austere, then you got to raise rates, and you got to raise them fast. Here are interest rate cycles by duration and degree going back over the last 5 or so. And as you can see, they range from, some increases in 99 to a lot of increases in 2004, all of which happened over a moderate period of time. Not this time. So Powell has jacked up interest rates from 0 to nearly 5% in less than a year. So policy Fed tool number 2, raise interest rates as fast as you can. He did that. And then policy tool number 3, shrink the balance sheet. Now this, just to make things simple, is quantitative easing, which is a fancy term for printing money out of thin air, right? And if you go back in this chart to 2008, the Fed printed about $1 trillion to get us out of the financial crisis. And then it printed another $1.5 trillion so to get us out of the European debt crisis. And then during COVID, it printed about $5 trillion to get us out of the quarantine crisis, if you will. So the printing press has been on hyperdrive. If you're trying to get rid of inflation, then maybe you need to turn that in reverse. And they're doing that. So their Fed policy tool 3 is to shrink the balance sheet fast. So they've literally erased $500 billion so far since they've started quantitative easing or tightening, and they're doing it at a pace of $100 billion a month, with their ambition to take away all of the $5 trillion in quantitative tightening or easing they did by the end of 2024. Not sure they can really pull that off, but that's what their objective is. And the reason they're doing that is because they're trying to shrink the money supply after they ballooned skyrocketed the money supply. So take this chart in. This is the change in total money supply in the United States of America going back to the early 80s and the percent change from a year ago. To offset COVID, the government printed a third more money than we had prior to COVID, right? Imagine that. For every $2 you had in your wallet, the government just came up with a third. And no wonder we have inflation. I mean, this was insane money creation, but they've done everything they could to shrink the money supply. And in fact, the combination of those higher interest rates, that tough policy talk, and the quantitative tightening has actually started to shrink the money supply. And I believe this is the first time that the US has shrunk its money supply since maybe the 60s, but I'm not even sure about that. I think you have to go back to the Great Depression to find when we were shrinking the money supply. But all of that policy austerity is showing up. Money supply that had grown at 30% is now shrinking. And all of this is calibrated right to bring down inflation and secure Jerome Powell's Volcker-esque legacy. So here's the consumer price index, all things considered in here, just the headline number going back to 2013 or so. And we peaked in this index at 9.1% when the Fed really started putting the screws to monetary policy. And now, 3 months later, we're sitting around 6.4%. So inflation has come down about 30%, but it's still far away from that 2% Fed target. But here's what really scares the Fed. This is what fills the Fed's head with dread. What they're really worried about is average hourly earnings. They are worried about wages. While inflation numbers, headline inflation, energy's come down, supply chains have opened up again, food prices will come down, and we're going to dig into more of all that stuff. But they're really focused on wages. Consumers represent 2/3 of the US economy. And so consumers are a huge portion of the inflation index. I'll dig into that a little bit more. So while headline inflation has come down, wages have been a whole lot stickier. And that's what really scares the Fed. They feel like they've got to do something about wages. So they have focused our attention to now what they call the super core inflation index. Super core inflation is basically the price index minus energy, because that pops around, minus shelter. The reason they're taking shelter inflation out, and I'll share this with you in a minute, is that shelter operates with a long lag. And so Jerome Powell directed our attention to this inflation index and said the following: this may be the most important category for understanding the future evolution of core inflation, because wages make up the largest cost in delivering these services. The labor market holds the key. So in the core PCE, this measure is about 50% of the activity in that index, or 55%. So Jerome Powell is very focused on wages because that's the segment that feeds into the largest portion of his favorite inflation index. So if you're really trying to kill inflation, then there's a fourth policy tool, and that's just kill the economy. Because if you go back, and this is 12 recessions, I think, and look at historical returns, prior to recession, you've got an average peak of 6.9% in inflation. A recession wipes that out almost to zero, meaning that because of recession, on average, during these periods, inflation had come down around 7%. So if you apply that to where we are today, inflation peaked at 9.1, you subtract 7%, you basically get to where the Fed wants inflation to be, which is about 2%. So if you really want to get inflation down, then perhaps you have to incite a recession. Now, that's bad news, but it could get worse, right? And I'm going to walk you through that. So let's talk first about what could possibly go wrong. Well, let's say it is the 1970s. I'm going to compare the path of the consumer price index today with the path of the consumer price index in the 1970s, and I'm going to index them for the peak, that 9.1 that we've looked at. So the good news is inflation's rolling over, but it did it in the 70s also. So inflation rolled over, the Fed eased, the government continued to spend guns and butter kind of money. Next thing you know, we had an echo inflation effect where inflation went far higher And then it didn't really come down until Volcker put the economy into recession, not once, but twice, to break the back of inflation. So if it's the 1970s, this inflation story is not going away. And the Fed does have a prescription. Like I told you, the prescription is pain. If Powell thinks that to break inflation, he has to incite a recession, then he's got to get the unemployment rate up. Well, the unemployment rate's been very stubborn and sits today at 3.4%, despite all of the Fed tightening, which is the same level we saw during Woodstock, right, back in 1969. So the Fed has broadcast through its summary of economic projections that the unemployment rate should tick up to 4.6%, which will help them meet their inflation target. Well, that's great news. Maybe 4.6% from 3.4 actually means 2 million Americans will lose their jobs, but yet we're not seeing Americans really lose their jobs. We got a very soft employment number today, or unemployment number, and here's why. For every unemployed American right now, which is 5-point-something million, there are 2 available jobs. So there are 11 million jobs for 5 million Americans, whatever the math is. There's still a great deal of imbalance in the labor market. There's much more labor demand than there is labor supply, which is bedeviling the Fed. And so the Fed's reaction to this is, we just got to try harder. The unemployment rate is not rising. We are not seeing relief in wages the degree we want to see. And so this chronicles the projections that they've made every quarter over the last 2 years for the degree of interest rate hikes they've got to make by the end of 2023. Every single meeting they have had over the last 2 years, they have told the marketplace interest rates have to go higher by the end of 2023. Now we'll get the next release, I think it's March 14th. I think that's right. We'll get the next summary of economic projections relief in March 14th. And while the economy has cooled a bit, it's caught a little bit of a tailwind early here in the year in January. So I would suspect this number maybe even goes up higher. But this is the pattern the Fed has been in. It's been hitting the brakes, hitting the brakes, hitting the brakes, hitting the brakes, but the unemployment market hasn't responded. And so unfortunately, the Fed could and typically does overshoot. So this is the Fed's projections for unemployment during tightening cycles and recessions going back, 1969 or so. And so typically what they think is the activities of the Fed will cause the unemployment rate to rise, call it 1% or so, right? And today it would be 1.2% is their projection. What actually happens? The unemployment rate tends to rise considerably more than that, to an average of 3.5%, making the missed projection about 2.5%. So if they're predicting that we're going to go from 3.4% to 4.6%, and you add in that margin of error, then maybe 7% is the unemployment rate that the Fed takes us to, because they tend to overshoot. Now, we're not talking about 2 million Americans losing their jobs. We're talking about 6 million Americans losing their jobs. And indeed, that would correlate with pain. And Chairman Powell better be careful. And here's why. If you look at economic indicators, and this is a chart that goes back to 2000 and shows you how many indicators are accelerating into year end. As we got to the year end of 2022, the indicators were really flashing pretty red at levels seen previously during the pandemic, 2008 or 2001, previous recessions. And the yield curve is definitely inverted and pretty steeply inverted. So this is the 10-year Treasury minus the 3-month Treasury. And you can see it's decidedly negative to a degree that corresponds to recessions in the 80s, when again, Volcker was creating recessions on purpose to break the back of inflation. So by this measure, which has a pretty good track record, the economy is headed towards a recession. And when the curve inverts that way, it's a disincentive to banks to lose money, because they pay short-term rates and they get paid long-term rates. And right now, 40% of banks are tightening their lending standards, and that corresponds to levels seen in previous recessions. And so banks are tightening credit I had breakfast with a guy, I think he was on the call today, and I asked him what's happening in the multifamily market in Nashville, which is really his, and he said nothing's trading hands, right? That things have just stopped. Whether people get financing or not, I don't know, but there's a huge bid-ask spread. Things are just a bit frozen. And our favorite recessionary indicator indicates recession. So this is the Conference Board's leading economic index. It's currently down 3% if you do a 6-month rolling average. That's levels consistent with recessions in the past. It also gives us a little bit of lead time and forewarns that recession would happen basically first quarter or second quarter of 2023. And so the indicators are blinking recession and they're forecasting it in the first half of 2023. And so if that's the case, then the bear market we're in, if Powell creates a hard landing, a recession, to channel Volcker, then this bear market could continue on. So here's the dot-com bear market. That market fell 50% over 929 days. That was no fun. But there were head fakes along the way. We were up 10, we were up 20, we were up 22, we were up 25. None of that stuck. We were in a downtrend that persisted for almost 1,000 days. Then you take a look at the great financial crisis bear market, and we were down 57% over the course of 517 days. And we had some reason for optimism. We had a 12% run, another 12% run, a 20% run, a 24% run. Those were all head fakes. We were in a persistent downtrend. And if we do have hard landing scenario or credit crisis on the table, and this is a longer term bear, then we're really just a baby bear right now. In 2022, the market fell 25%, peak to trough. And that's occurred over 282 days, going from January to, call it, October 13th. And we've had some encouraging movement. We were up 13, 10, up 19, up 18. But if we're going to have a hard landing, we're going to have a big recession, if we're going to have a credit event, then this is probably just a baby bear so far. And when you poll global fund managers, and this is a poll of 100 of them, and say, hey, where do you expect the stock market to be at the end of 2023? They're pretty bearish. So overall, and this is the grid, we're at 4,100 today, or at least we were before I started this. You know, it's a wide divergence of opinion. We got some that say we'll be below 3,000 by year end. Then we got some that are crazy and think we're going to be above 4,600 by year end. But the average of all these professional fund managers is it will be at 3,890 by year end, which is about 6 to 7% lower than we are today. But that's just this year. If this is actually the 1970s, then it's going to be Blue Mondays for a decade. So if you go back and look at 1970s asset class returns, if you wanted to beat inflation, which was 6, 7%, you owned gold and you owned real estate. If you were in cash, stocks, or bonds, adjusted for inflation, you lost money for an entire decade. So that is what can go wrong. Now, you're probably depressed, and rightfully so, but I've got a twist here. So let's talk about now what could possibly go right. This is not the 1970s, okay? Let's take that off the table, and here's why. And this is a global consumer price index. People tend to operate, somewhat consistently in terms of policies at different periods of time. And so the global consumer price index just takes everything in. So here were consumer prices in the 70s. You could see on average, they were sort of 10% plus. And then things cooled down from there. But the reason that they were 10% plus is because it was policy related. The policy of the governing authorities, be they the central banks or the fiscal authorities globally, was basically to just stimulate. And it was flawed economics. And I can take you all the way through it. But just suffice it to say that was policy related inflation. The inflation that we're experiencing right now is wartime inflation. You can see how much the money supply grew in 2020, as we've talked about, but now that money supply is crashing back down just as violently. So there was a spike in money supply growth that's being absorbed. In the 70s, it was a long duration of policy choices that kept money supply growing at a very high degree. That is not where we are today. I believe this is more like the post-World War II environment. And so I'll go back to mapping the two inflationary directions. So 2020 to 2022, obviously we had the peak. Here's what happened after World War II, which was obviously wartime inflation. You did see an echo inflation period 49 to 51, but then it burned off and was rather benign the whole period. So we had inflation as we fired up the war machine, but then once we turned it off, inflation came back to very benign, more normal levels. And so let's dig into inflation today, and you can see some encouraging trends. So this is goods inflation within the CPI. Now, goods inflation, and I'm doing this quarterly annualized, peaked at about 24% back in 2021, but really that was peak quarantine, right? We were all buying Pelotons, we were buying furniture, we were buying, used cars. There was a shortage of production. It was all goods related inflation because the service economy was shut down. So that was really peak quarantine inflation. And then the supply chains opened up, inventories rebuilt, and we bought all of the, furniture that we could handle. Well, once we had reopening, then there was all this revenge travel and revenge sort of dining out and all these things. We've been cooped up in our house. Finally, we had a vaccine. We went out and we put a lot of pressure on the service industry, and that created a lot of inflation within the services industry. So we had peak quarantine, goods inflation. We had peak reopening, services, less rent inflation. What about shelter? Well, shelter lags, and it lags significantly. And here's why. The average American stays within their house for 13 years. They stay within their apartment for about 1 to 2 years. And so those don't reprice very often. So you get this huge lag in performance in terms of shelter. But are we at a level now where we're seeing peak shelter inflation? I think we are. Part of the reason the Fed jacked up rates so high was to make your mortgages go up a bunch to help, puncture some of the excesses in the housing market. And so right now, the annual mortgage cost as a percentage of household income is about 45%. And that's dramatically higher than the 20% we had during COVID. And so if you add that into other factors and say, what's the affordability of housing in the United States of America right now? Housing in the US for the average family is less affordable today than it was prior to the great financial crisis. So housing prices are destined to come down. And here's a model I pulled that I think Steno Research did. And basically they projected forward what housing prices will do with the data set that I just shared with you. And by their calculations, housing prices, which have already started to fall in various areas, could overall fall by 20%. That is disinflation. But if you're not buying that, because the CPI shelter index continues to go up, let's look at what's going on with shorter term rental rates. And for that, we can rely on the Zillow rental index and the apartment list, which is new apartment leases. And obviously, those rates have started to roll over. While still positive, the inflation rates have come down significantly. So I do believe that peak shelter is behind us as these current measures are falling fast. And so what does the market expect the Fed really to do? This has changed a lot in the last, call it 7 days. So the market expects the Fed to raise 1 or 2 more times in 2023. But then as inflation ticks lower, or if there's a mistake and recession starts to bite, they expect the Fed will cut rates maybe by the end of the year, but certainly next year. And so when I put this slide together a couple of weeks ago, they were expecting a 3% Fed funds rate by the end of 2024, compared with where we are today at 4 3/4. And so if take a look at the labor market, we haven't seen firings, right? And that's what the Fed wants to see. They want to see 2 to 6 million Americans lose their job. That's how their model works. So we haven't seen a tick up yet in jobless claims because there are 2 open jobs for every unemployed American. But we have seen hiring actually slow. So hiring has started to decelerate. And then you've heard about quiet quitting, which was when the employee goes to work and they don't actually do anything. Well, this is quiet firing, where they come to work and you say, you know what, take a day off, right? So the hours worked across the economy actually is going down. So you haven't fired the employee, but you have reduced their hours. This is the most important slide in the presentation, and this is the linchpin for my optimism. One of two, I'll share the other with you. Right now, I think there's a Goldilocks possibility in this economy. So I'm going to compare wages and the unemployment rate going back over the past year or so. Over the past year, the unemployment rate has ticked down from, call it 3.6 to 3.4%. So the unemployment rate is falling, more people are going to work. Over that same period of time, the inflation rate for wages, average hourly earnings, has fallen from 6% to 4.4%. So average earnings inflation has fallen 1.6% while the unemployment rate is going down. How can that happen? If you go back to when COVID struck and the government forced everybody to go, put on their pajamas and not go outside, companies fired 14 million people, most of which were frontline workers in the service industry. Then when we reopened the economy and we had all that revenge dining out and travel and all that stuff, everybody needed those frontline service workers back, right? And so now there's a shortage of these workers based upon the demand. So companies don't really want to fire those people. However, they got to fire somebody to preserve their margins. So I think what's happening is companies, and we've seen this at FedEx, and we've seen this at McDonald's, and a host of other employers are looking at their administrative management bureaucratic structures and saying, there's a lot of fat we can cut here. And so maybe we can reduce management redundancies, maybe we can streamline operations. All of that squeezes out more corporate efficiency, which is really great. But you get a lot more bang for the buck if you fire somebody who makes 250 grand a year than if you fire somebody that makes 50 grand a year. And so if wages can fall, if we're trimming at the top of the org charts rather than the bottom in this cycle, then wages can fall even though the unemployment rate isn't rising as much as history might suggest it would. So that sort of tactical firing in the higher wage positions is a net positive. It's net negative, obviously, for those people, but it's a net positive for the economy overall and also for corporate earnings going forward. All right. And if it's recession, there are two types of recession. One where you have a crisis like the Asian flu in the 50s or COVID in 2020, the Great Financial Crisis or the Great Depression. If you have a crisis with your recession, then your average decline in GDP is 13.5%. If you don't have a crisis and it's just your garden variety end of the business cycle, then the drawdown in GDP is only 2% or so. I've highlighted 80 and 81 here for you because those were the Volcker recessions. Down 2.2, down 2.6%. Neither of those had a credit crisis really, and so they were rather benign events. And if you're not going to have a severe recession because you don't have a crisis, you just have a recession, then a mild economic recession usually just pretends a mild earnings recession as well. So if you go back to those non-severe recessions over the past 50 years or so, earnings have come down on average about 10%. And go and take a look at 80 and 81. In 80, earnings were down about 3, and 81, they were down about 13. So 8% on average between the two of them. That's frankly no big deal. And in fact, even with the markets up 8% or so year to date on the S&P, they've done that knowing that analysts are forecasting a 9% decline so far in earnings, troughing in Q1 of 2023. Who knows, maybe Q2 of 2023. Anyway, markets are going up knowing that earnings will fall, by their historic average in a non-severe recession. And here's the other interesting thing. Markets rise before earnings rise. So the stock market bottom, this is the past 12 equity bear markets showing you the pattern. You have this bear market low, obviously, and you have a recovery. And I'm going to base that at the 0 month. If you look at earnings, market ends up bottoming well before earnings bottom. In fact, the markets end up bottoming 6 to 9 months before earnings bottom. So let's take where we are today. Here's the path of the S&P 500 over the last year or so. The market's bottomed on 10/13/2022. They've gone up, so that's 11, 12, 1, 2. So it's been 5 months so far. If it's 6 to 9 months before earnings bottom, then we're looking at first quarter, maybe second quarter for the earnings bottom. That is right on track with the historic norms. And now let's go forward a little bit more. So this goes back and looks at historical earnings for the S&P 500 going back to 2013 13. And obviously 2023, maybe it's positive, maybe it's negative, basically flat on the year. That's what's currently projected. But when you get out beyond that and we get into a low inflation environment, legitimate recovery, there's going to be a lot of operating leverage within corporate earnings. So we go from, call it 220 to 250. So there's a hockey stick higher expected in earnings once we hit recovery. And by the way, when I go back and I look historically at investment returns around recessions, and this is the past 12, you see some where you have major credit events like 2008 or 74, 75. There's some that had, significant issues going on. COVID obviously down 34%, but the median drawdown in all the recessions, even those including the crises, was 24%. Last year, we went down 25%. So I think the recession returns have actually already happened. And the recovery returns end up being tremendously robust. So once you get past sort of your recession returns, your recovery returns 12 months later on average, you're up 30%. 24, 2 years later on average, you're up 35. 3 years later, you're up 46% on average. So my belief is the markets gave us this year's recession returns last year, and we're going to get next year's recovery returns this year, and that's bullish. And I do not believe, obviously, that we're in the 1970s. And so if a better proxy is the post-World War II period, here are what asset class returns were between 45 and 55. If you were in cash and gold, you lost money relative to inflation. If you were in stocks, real estate, or bonds, you made money. So there's a very different spin between an inflationary environment for investors, persistent inflationary environment, and sort of this wartime temporary inflationary environment, which I think we're in right now. All right, so hopefully you're feeling a little bit better. Now the question is, how do we make money in this environment? Because we want to maximize the recovery returns. So we believe the US dollar down cycle has really begun. And so this is a measure of the US dollar, which, by the way, is the most important asset on the planet. It's not stocks, it's not bonds, it's not crypto, it's the US dollar. It is the largest, most liquid asset on the planet. And if you tell me in any given moment, and I bet right now, based upon the PPI number this morning, the dollar is up, which means the market is down, which means yields are up. If you can tell me what the dollar is doing, I can tell you what everything else is doing, right? Well, right now, the dollar is about 14% overvalued, coming down from 20% overvalued back in September of last year. The last time we saw a down cycle like this, it started in 2000, it ended in 2010. So these dollar cycles tend to be kind of long-winded. So it could be a down cycle for the next decade. And here are the average equity returns when the dollar is down. Actually, a weak dollar is pretty good for the S&P 500. So the S&P on average does better than historical norms, up about 12% on a rolling basis. But look what happens in developed international markets. And remember how cheap they are right now. So with the dollar declining, you get a tailwind in foreign currency. Developed internationals over the period up about 20%. Here's what happens to emerging markets, which are the most elastic, the most levered to movements in the dollar. Emerging markets up over the periods when the dollar is down, up about 35% on average. So we are going to stay international with this portfolio. We're also going to continue to stay small. Even though small caps outperformed large caps, depending on which indice you're looking at, last year, they're still 30% cheaper than large caps. And the last time we saw them hit this level was again back in 99, early 2000. Internationals were outperforming. Small caps went on a run as well. We think that history repeats. Talk a little bit more about that in a moment. And then we're going to stay value biased. Yes, there was an uptick in value versus growth last year, but that was after 15 years of underperformance. And if you believe in reversion to the mean, which I do, then value is overdue for a run, and we're seeing that now. Even with the jump in the NASDAQ so far year to date, if you compare the value and growth styles, they're actually even. So you've sort of gotten this relief rally in the crazy high value kind of stocks, but if you look at them overall, the two factors are still dead even. So we think that the value style will continue to outperform. And if the best analog for right now is not the 1970s, maybe it's not the post-war period. In my belief, when you put it all together, it looks a lot like 2000 to 2010. And over that decade, if you wanted to beat inflation, the way you did it was in international stocks, value style stocks, and small cap stocks. That overvaluation in tech land in 1999 took a decade to burn off. So large caps growth in the US dollar all underperformed inflation in that decade. So we're using that as our primary sort of intermediate term playbook for our investment theses. On the bond side of the equation, and I'm almost finished, on the bond side of the equation, guess what? You don't have to overthink it anymore. Bonds actually have yields. So as we ended 2021, you could have gotten 1% on munis, you could have gotten 4% on high yield. That wasn't all that compelling. But after the comeuppance in the bond market last year, now we have yields again. So you get 3.5% on munis and 9% on high yield. So you don't have to overthink your bond allocation anymore. Just buy bonds because you get paid, which you haven't in a long time. So here's the bottom line for 2023. We believe equities will grind higher. Again, we think we got last year, the recession returns of this year, last year, and we'll get the recovery returns of next year, this year. So we continue to be optimistic about where equities go. From a size perspective, we're sticking with the script. I like the lower valuation of small caps. I like the lower performance, relative performance of value over the last 15 years. And I like the internationals for the purposes of a currency tailwind and also a much more attractive valuation array. So we think the dollar will go weaker as the Fed does sort of reach the pause phase. There's still inflation bedeviling investment bankers overseas. Also, if risk appetite returns or if there's a ceasefire in Europe, you'll see currencies start migrating offshore again. So we think the dollar ends up continuing this projected weaker period. In terms of interest rates, by year end, they're going to be lower, I think, because you either see inflation rolling over or the Fed's bitten so hard that we're in recession and they got to cut rates to offset the damage done by the recession. So we think interest rates will be lower by year end. In terms of bonds, don't overthink it. Be jubilant. Last year was terrible, but now we have yields again. So just go get some bond yields. And in terms of the primary threat, it's the same. If this man's thinking all about his legacy and he wants to be seen as Volcker-esque and not Burns-esque, then he's going to continue to be austere. But if he doesn't relent, then ultimately he can invite a hard landing scenario, break something in the credit markets, and put us into a much more damaged position. But I don't think that's the case. So I'll end with this, right? Since the whole idea of this presentation was the power of perspective. So remember when we started, I talked about how bearish the average investor is at a record level. Only 25% of investors surveyed at the end of last year thought that the market could go up over the next over the next year. So I went back and did the homework and looked at the weekly results from that survey going back to 1987. And I stuck it into categories: 20 to 30% bullish, 30 to 40% bullish, 40 to 50% bullish, 50 to 60% bullish. So when people are most pessimistic, on average, between 20 and 30% bullish, markets are 17% higher over the course of the next year. When they're less pessimistic, 30 to 40% bullish, markets are 11% higher. When they're feeling pretty good, markets are 7% higher over the next year. And when they're super confident, 50 to 60% bullish, on average, markets are lower over the next 12 months. So here's what I want you to always remember when it comes to the power of perspective. Pessimism pays. I get most excited and most pleased when people are most bearish because it means they've already positioned themselves for the declines. Now what's happened as the market's rallied is that people have seller's remorse. They're trying to figure out how to get in. And so on days when the market sells off a lot, you see them sort of trickle back up. And that's because people are 8% behind their benchmarks because they expected this environment to be terrible, and it has yet proven to be that. So I want you to all remember this when it comes to the power of perspective. Pessimism pays, and I think we get paid on that pessimism this year. And with that, If you're still with me, I'm happy to take questions.
All right. Thank you, David. That was a great presentation. A lot of information and enlightening as usual. First question, I had a lot of questions roll through here. Talk to us about the debt ceiling and the default risk in the US and what that means for investors.
So the fear on the debt ceiling is that we default on our debt. The S&P downgrades our credit quality and interest rates go through the roof, a la Europe. This happened during the Obama administration, if you remember. We couldn't resolve the debt ceiling. S&P downgraded the US credit rating and interest rates fell. The reason interest rates fell is because the US is the world's reserve currency. And when the globe gets nervous, what they do is they buy treasury bonds. So perversely, when we actually did have a credit downgrade because we messed up the debt ceiling, bond yields went down, not up. Remember, in Europe, they went through the roof. In the US, because we're the reserve currency, they went down. So this is political theater. We go through this debt ceiling thing every 6 months or so. I think it's a non-event. And in fact, if we end up getting downgraded, that means lower interest rates, which means higher valuations. It's probably positive for stocks. So again, pessimism pays on that one too.
All right. Second question, the Fed got it wrong in 2021 when they determined inflation to be transitory. What is your confidence that the Fed will get it right and return the target 2% inflation?
I'm not sure how long it will take to get to 2% inflation. What I wrestle with is, I mentioned we had a $20 trillion economy in the US. The Fed pumped 10 trillion, well, the Fed plus the fiscal authorities pumped 10 trillion into that economy, right? So there's an enormous amount of money in net worth and on bank balance sheets, corporate balance sheets. There's just never been more money in people's hands than there is today. So it may require the Fed doing more to try and slow this economy down. But I will remind you that the long-term rate of inflation in the US is actually 3.5%. It's not 2%. So that may be their target, but we've been running 3.5%. And that includes the years that we were on the gold standard. So we've actually operated the economy at higher inflation rates than today. And yet, we still generated a bunch of returns for stocks, bonds, et cetera. So the Fed may have to do more. They may have to go another quarter point, another half a point, et cetera. I don't really want them to, but the reality is they pumped the economy full of so much ballast that they've got to do a lot to try and disrupt things to bring that inflation rate down. So can the economy, still operate and do well at 3.5%? I think it can. Where do I think we end the year? I bet we end the year around 4%. We're at 6.4 today. If I look into next year, maybe it's 3%. So it takes a little time if you avoid sort of that hard landing scenario. So I'm not sure 2% is a magic number. In the past, it's been 3.5. So if we run a little bit above 2%, who cares?
All right. So with recent data coming in better than expected and the market already having a good start to the year, what does that mean in your opinion for the rest of the year?
So that's a surprise, right? Economists project recession, investors project recession, investors, home retail investors project bear markets, right? So everybody came into the year expecting this whole thing to fall apart. And quite frankly, the economic data in December was pretty scary. Retail sales were bad. It was just, it was not pretty. January, we saw this revival in economic statistics. We got a little bit hotter inflation read this week and even this morning. But I don't expect inflation to go down in a linear fashion. You're going to have sort of these head fakes along the way. Point is, maybe the hard landing scenario became the soft landing scenario. The soft landing scenario became the no landing scenario. If that's the case, then the Fed will have to do more. But recall that typically in rate hiking cycles, stocks go up because earnings are going up because the economy is growing more than the Fed would like. So it's a little bit of a double whammy. It's good news for corporate earnings because obviously the economy continues to grow and that's good for corporate earnings, but it requires more action by the Fed, which maybe increases the probability of a mistake and a hard landing at some point. So I would say in the near term, it's positive for corporate earnings. In the longer term, it introduces maybe a harder landing scenario, but that's something we'll continue to monitor. So it's a net positive really in the short term.
Great. Well, thank you, David. That's all the time we have today. We will respond to all of your questions that were submitted. So if you have any additional questions, please reach out to your WNA wealth strategist or email us at request@wealthstrategist.com. All of you also, you can stay in the know by signing up for our weekly email if you haven't already. Every Sunday, we send out our insights on global economics and how it impacts your financial world. It's also the best way to ensure that you don't miss out on any of our upcoming events or presentations. So head over to our website, wealthstrategist.com, and sign up. And thank you again, and we'll see you next time.
Yeah, and I'll close just by saying this. Thank you, Sean. One of our core values is that gratitude inspires us. You know, our gratitude for having the jobs that we have, for giving us the opportunity to serve you and your family. And the best way that we can demonstrate that gratitude is to really work as hard as we can to deliver on the outcomes that all of you want. So an enormous amount of work went into this presentation, and it went into that because we're super grateful for your trust in us, your confidence in us, and we take the responsibility of being stewards of your asset very seriously. So with that, I will close. I will say thank you for the attention. We will have a replay. If you missed something or you want to go back to it, you're welcome to email me as well. And with that, enjoy the rest of your day. Thank you, everyone.